Yes, I'm here to share with you about the Fed's decision on raising interest rates in July. Decision released today. And after the release of 25 basis point interest rate hike, the Fed's interest rate is at the highest point in 22 years. On Wednesday, the Fed raised the U.S. Fed benchmark interest rate by another 0.25 percentage points, reaching the highest level in 22 years, while also opening the door for further interest rate hikes this year. The FOMC unanimously agreed to raise interest rates to target range of 5% to 5.5%, restarting the most aggressive monetary tightening in decades. Prior to this Wednesday's rate hike, the FOMC paused rate hike at its last meeting in June. At that point, the FOMC kept its benchmark interest rate unchanged. The Fed Chairman Jerome Powell said at the time that the Fed would take a more gradual approach to raising interest rates to absorb the impact of earlier interest rate hikes and deal with the crisis at the local U.S. banks this spring. The FOMC said in a statement that inflation remains stubbornly high, while U.S. job growth has been strong in recent months and economic activity is continuing to expand at a moderate pace. The committee also said it remained highly concerned about inflation risk and will continue to assess more information and its implication for monetary policy. At a press conference after announcing the rate hike, Powell declined to say whether the Fed would raise again at its next meeting in September. I'll say if the data is well-founded, we certainly have the possibility of raising interest rates again at a September meeting. He said, we may also choose to leave the rates unchanged at our next meeting. We'll conduct careful assessment at each meeting. Fed's rate hike did not have a big impact on the markets. U.S. stock and the U.S. Treasury yields edged lower on Wednesday. Traders in the interest rate futures market currently expect a roughly 50% chance that the Fed will raise rates again later this year. We have taken into account many aspects, and the full impact of our monetary tightening policy has not yet been felt. Powell said the committee will take a data-based approach to determine whether the further interest rate hikes are necessary. He believes that the Fed's rate hike has succeeded in bringing inflation under control without materially negative effects on the labor market, which is a good thing. However, strong growth over time will lead to higher inflation, which would require more tightening by central banks. Rice tells that monetary policy has not been restricted long time enough to fully exploit the desired effect. However, Powell's comments also raised expectation for a soft landing by the Fed. He noted that the Fed's economists have now adjusted their forecast to believe the world's largest economy will not fall into recession. Forecasts show a significant slowdown in growth starting later this year, but given the resilience of the recent economy, we no longer see a recession. Currently, the Fed is raising its benchmark interest rate to more than 5 points from near zero in March 2022. Bringing it a sufficiently restrictive level of credit costs to achieve its long-term goal of reducing inflation to 2% in time. Powell said last month that the Fed was not far from that goal. However, officials have refused to roll out further rate hikes to preserve leeway to deal with persistently high inflation. Consumer price index in the U.S. showed annual inflation rate of 3% in June. A complication of the Fed is that the economic growth has now broken expectations of a sharp decline this year. The labor market, while cooling, is still very strong, which has boosted consumer spending. Headline inflation has declined as energy and food prices have fallen, but the core measure strips out these volatile costs remain well above the Fed's target. Officials raised their core inflation forecast as measured by personal consumption expenditures price index last month on concern that some price index increases, especially in the services sector as a whole, remain high. Just at the same time, they also raised their forecast that the U.S. federal funds rate will peak this year. In June, most officials expected the benchmark rates to reach 5% to 5.75%, letting at another jump 0.25 percentage points after July hike. However, many participants and economists are skeptical that the Fed will continue to raise interest rates this year. Bob Michael, Chief Investment Officer at JP Morgan Chase & Co., Asset management said, "We don't think the Fed will raise interest rates anymore. We're seeing enough signs of easing inflation. By the time of the September meeting, it is likely to be evident in both inflation and economic growth." After the July meeting, the Fed will hold its next meeting in September when the Fed will have 2 rounds of monthly employment, inflation, and consumer spending data. Christopher Waller, one of the FOMC's most hawkish members, recently said that the September meeting would be a live meeting, meaning that the Fed would only raise interest rates by then. However, many economists believe that the threshold for the Fed to introduce more tightening in September is high. If the data show it is necessary to raise interest rates again, it is more likely that it will be at the November meeting. That's all I have for today. Thank you for listening. Don't forget to subscribe and see you next episode.